Hi everybody, this is Chuck Gibson from Financial Perspectives with my monthly market recap for May 2015. I have a lot of charts to show, so I'm going to have to run through them quickly in order to keep this video at under 10 minutes or less. So let's get started. The first chart is that of the total U.S. stock market. You can see that while the uptrend continues, momentum in the upper pane is falling. In addition, the rising wedge in red still has my eye, but to be a true wedge, it looks to me like it needs one more push up to touch the upper trend line before it can be an official wedge pattern. These patterns have a 69% probability of being bearish and breaking out to the downside. The measured move on a breakout is about 9 to 10% in the direction of the breakout. Because it has been so long since we've had a significant correction, if this pattern opens up the door for the downside, by no means does it mean it will stop at the measured move. A decent correction, which would be healthy for the continuation of higher prices, would see price fall below the bottom of the rising blue channel and ultimately to the 200-day moving average. My next chart is the monthly performance for each of the major U.S. sectors. The standout to the upside was once again healthcare, with more than a 3% gain for the month, followed by banks, which got a boost as interest rates continued to push higher. To the downside, the clear loser was energy, losing more than 5% for May, reversing what had been a good couple of months to the upside. The saying is the banks have to do well if the economy and the stock market is to do well. My next chart is that of the banking sector and shows it has broken out of a 17-month consolidation and made new highs. This is a bullish sign. My next chart, that of the 20-year U.S. Treasury bond, shows that for the majority of the month they continued the correction that started in March, but bottomed at a very important support line to close the last week of the month on an up note. The bounce is constructive, but this recent correction has my attention. As you can see, we have not only breached the blue support line, but we have also created a lower high and two lower lows. With this next bounce higher, if price does not exceed the prior high of 132.21, I will be forced to take action and reduce interest rate exposure in clients' portfolios, as that signals a new intermediate downtrend in bonds has begun. The next chart is a 6+ year look at the emerging market stocks. You can clearly see they have been in a sideways trading range for more than 5 years. Anyone invested in this market has seen little to no returns for that entire 5 years. A long-term investment here would have been dead money, except for those nimble traders who were good enough to sell at the top and buy at the bottom of the channel. This is a great example of why our process tells us to step aside when investment no longer exhibits upward movement and is in a lengthy consolidation. We have been a strong advocate that clients should avoid the emerging market equities until they have begun a confirmed uptrend. There are just too many other investments that are trending higher that provide better alternatives. In my next chart, a monthly look at oil, it shows how important that rising blue uptrend line has been over the long haul, as each major correction over the last 20 years found support there. Note in the upper pane how the last decline oil reached its most oversold condition in the entire 20-year look back on this chart. Also note in the bottom pane that each of the prior two times the slow stochastic fell below 20 and then crossed back above, how it presented a wonderful buying opportunity, doubling in price. One has to ask, will this time be any different? I continually get questions on precious metals and the miners, so this month I thought I would check in and see how the gold stocks are faring. As you can see in the next chart of GDX, the miners have been in an ugly and rather steep downtrend since their peak in 2011. Of course, there have been some counter-trend rallies, but each bounce has been rejected at the upper trend line. Until price can break out of a channel, form a higher high followed by a higher low, any commitment of your investment dollars is, in my opinion, both foolhardy and just an attempt to catch a falling knife. At some point, though, both the metals and their stocks will be an excellent investment, but that time is just not now. It's my expectation that when that day comes, it will likely be a long and very profitable investment. My next chart is a look at EFA, which is the developed countries of the world, not including the United States or Canada. What you can see is that it has moved up nicely from the divergent double bottom buy signal that was created back in the first part of this year, but has since hit resistance and stalled at the prior high formed back in June of last year. I want to point out that as a trend follower, it is important to understand that just because an investment is in an uptrend does not mean it's worth owning. As you can see, this ETF has been in a well-defined uptrend since May of 2012, rising more than 60%. In the bottom pane, I show a ratio of this investment compared to the US S&P 500 index. What it shows you is that owning this rather than the S&P during that time period would have had you underperforming by more than 30%. While diversification is important, you need to ask yourself, would you rather have a portfolio that conforms to a 60-year-old theoretical study that some argue may have lost relevance? Or would you rather make more money? My preference is that if you're going to take stock market risk, then you need to be rewarded for that risk. And underperforming by 30% is just not an option. I wanted to close out this month's recap with a very long-term look at the U.S. stock markets. The longer-term weekly or monthly charts are excellent at giving perspective of market direction without all the short-term noise. As a market technician, our credo states that until the weight of the evidence provides confirmation otherwise, you must give the benefit of the doubt to the current trend. There should be no question from my next chart that the current direction is up. While the direction is up, as I have alluded to in past videos, not everything in Mudville is joyful. I apologize for the complexity of this chart as I normally try and reduce the amount of information I present. But in this case, I wanted to include a few of the many indicators and systems I use to manage and make investment decisions. The second pane from the top is the monthly price of the total U.S. stock market over the past 20 years. While I would have liked to have gone back further, I have maxed out the limit of my charting software. 20 years is enough time to be able to revisit the past two major market declines of 2000 and 2008, as we want to ensure that when the next one of those occurs, and it will occur, we capitalize and profit from the move rather than be a victim. The upper pane is a measurement of price momentum, and what you can see is that at each major top we have had divergence in momentum, which I have highlighted with the solid blue line. Remember, divergence occurs when momentum falls and price rises. Those physics and math lovers out there know that if momentum continues to fall, price will eventually have to follow suit. I have added a moving average, which is the red line, to smooth out the data. What you can see in the prior major market corrections, that after the moving average has crossed above the 70 level to the upside and then crossed back under it, which I have marked with the dashed blue vertical line, that cross under has turned out to be an excellent time to sell stocks, albeit a little early for the 2000 decline. In case you cannot see, the moving average right now is just above 70 and therefore not signaling to sell. Moving down to the bottom two panes are two other indicators that I follow. They provide additional confirmation and have been historically very good at providing market sell signals once the indicator crosses over its signal line. As you can see, both indicators have recently signaled it's time to sell stocks. While indicators are very helpful in interpreting what the market is telling us, the final arbiter is price. Indicators only confirm price, and price right now is saying it's still in an uptrend. No questions asked. Don't fight the trend. That being said, unless stocks can kick into gear here and push strongly higher to correct the weakness reflected in the indicators, I continue to be bullish, but on high alert. As always, I appreciate your time and attention and hope you have found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with the May Monthly Recap.